This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engines so that more folks can also discover and engage with all things microcap stocks. First off, again, I thank you to everyone who participated in Planet MicroCap Showcase Vegas 2024. This was our biggest event to date, and that's thanks to all of you. I'm already excited about what we have in store for the rest of 2024 and especially for 2025. We're taking everything up a notch, and I'm very pumped to share more information with you soon. Speaking of Vegas, I'll keep the intro short and sweet. We recorded a live podcast in Vegas featuring Artem Fokin, Ben Claremon, Sam Namiri, and Michael Liu. We had an awesome conversation with some great questions from the audience as well. So thank you again for tuning into the Planet MicroCap podcast, and please enjoy my live podcast with Artem, Ben, Sam, and Michael. Thank you so much for just all your engagement, being here, and just seeing all these keynotes and amazing speakers and panels today. I mean, I truly think this is the best lineup we've ever put together, and I'm just so thankful that to everybody who I see that's in here that did speak, and to the 4 gentlemen here. And so we're going to try and close out strong, at least as strong as we can, before the networking event tonight. My name is Robert Kraft. You can follow me on Twitter X at Bobby K. Kraft. That's BOBBYKKRAFT. And I host a podcast called Planet MicroCap Podcast, and hence the name of the conference, Planet MicroCap Showcase. And we try and do our best to highlight some of the best small micro nano cap investors that we possibly can, and have really engaging conversations talking about their strategies, interesting trends, ideas, and whatnot. So every year we like to close out this day with a live panel for an opportunity to throw some tomatoes at me, maybe throw lettuce, whatever, floats your boat. But, I'm really excited to welcome the following 4 managers here on the panel with me. Joining me right now, we got Sam Namiri from Ridgewood Investments. We got Ben Claremon from Devonshire Partners, as well as Artem Fokin from Caro-Kann Capital, and Michael Liu from Intelligent Fanatics Capital Management. 4 of not just my favorite people to speak to on small micro nano caps, but just 4 of my favorite people to talk to in general. So, to start us off, I figure for those that don't know who each of you are, maybe we can do a quick 30 seconds, a minute on who you are and your firm. So I'll go start with Sam.
Hello, I am Sam Namiri from Ridgewood Investments. We're an RIA, and I'm with about $330 million in assets. I manage our small and microcap portfolio, and I think that's the quick 30-second background.
That was like 20. That was pretty good. Ben
Claremon, Devonshire Partners. Devonshire Partners is a private equity firm focused on small businesses that can be public or private. And so I am here as someone who spent a lot of time in small and microcap on the public equity side and is now focused more on the private equity side.
Very cool. Artem?
My name is Artem Fokin. I run Caro-Kann Capital. This is hedge fund, invest mostly in microcap and small companies. Run about 50 million in assets under management.
Michael?
I'm Michael Liu, an analyst at Intelligent Fanatics Capital Management. We're a long-only, high-quality microcap-focused fund, concentrated about 20 to 25 million under management.
Very, very cool. All right. First topic that I want to discuss here today, since we're all now gathered here in Vegas to kind of get really a sense of what's going on in the microcap markets. So this topic is the state of the microcap markets. We're through the first third of 2024. We've seen signs of optimism. Signs that we're getting ahead of ourselves, that we're in a risk-on environment again. Just a lot of different takes and fits and starts and whatnot. So I'd love to know from each of you what has stood out to you, or maybe some interesting trends that you've seen thus far in 2024. So Artem, you want to kick us off?
Sure. I think one interesting trend that I observed is the radical difference in behavior among many executives and CEOs and CFOs in 2023, mostly second half, and 2024 versus 2022. Specifically, as it relates to capital raising. I think for many microcap companies that assumed unlimited access to equity fundraising in 2020 and 2021, 2022 came as a big surprise. And now, behavior of many corporate executives reminds me of a cat who sat on the hot stove once and never sits on the hot stove again. However, that proverbial cat does not sit on the cold stove either. This is what I mean. I've observed that a number of executives, as soon as the capital markets window opened again, they rush to that without thinking very carefully about either the timing of the capital raise, about the structure of the offering, what does it entails? Does it entail only straight share, or is there more attached securities? And also did not really think through about how they will deploy that capital. Sometimes there are good use cases, sometimes, based on my opinion, based on the outside world, it's not. So, but that's one thing that stood out to me.
Very cool. Michael?
I'd say something I noticed in the last couple of years really pick up is there's a very aggressive and renewed focus on capital allocation with among investors talking to microcap management teams and the management teams realizing that the stock's not going to go up just by executing in a bear market. Sometimes you have to force the value creation with dividends and buybacks. And I think there's a much bigger focus on that. And it's sort of, you can play it either way. You can say that, companies that don't have good capital allocation that get a good investor advising them to do a buyback or tender at a good price because we're in a bear market is a good investment opportunity. You can also say the other way, that the companies that are doing well that just don't have it reflected in their stock price because they're not willing or unable to force quote-unquote value realization with capital allocation might be good opportunities here as just normal operating businesses start getting bid up again.
Sam?
I think it's always the case, but volatility, I think has just been crazy. Things, a company misses in a quarter or has a bad quarter, and I feel just like the stocks have been getting crushed for much harder and much longer in, I'd say the first part of this year. And I think, a lot of the different indices have come back, but if you look at, whatever you track with microcap, it's definitely not come back nearly as much as the others. And so for me, I just see there's a playground of a lot of amazing good assets that are able to get acquired at pretty cheap prices today. The question is, how can you find one that has a catalyst that you can extract that value, whether it's capital allocation or some other event, or growing profits or earnings per share. So that's really what I've seen is things are going down much faster and things are going up much faster based on news. What's tough in the microcap space is that earnings doesn't come out at the same time. It comes out much later, right, than larger companies. So I always feel like my companies always come out with good earnings reports on days the market just goes up, and it just gets lost. So anyway, that's kind of what I've noticed.
Should say something to him. So Ben?
I guess I have the luxury of focusing completely bottom up and on its individual companies, and I don't look at indexes and don't really worry about what's going on there, and that's the way I prefer it. I think what I see approaching companies with a very different perspective than I did when I was a public company only investor is I just see a fair amount of disillusionment with everything about being public, whether it's the cost of being public, whether it's the time associated with being public, whether it's the persistent undervaluation that a lot of management teams feel like their stocks trade at. So, obviously there's some self-serving commentary here, but I mean, it's and maybe it's the way that I phrase my questions, but it just feels to me like there's a lot of people who, maybe a few years ago were excited about being, microcap management team and all the growth opportunities they have, and then they've run into a situation where there's rates are higher and the cost of equity is much higher, so there's just a lack of capital available to them, and so the benefits of being public seem to to whatever perceived benefit has seemed to diminish. And so, obviously, if microcaps were a better performing asset class, maybe that changes that perception. But I consistently hear from management teams that there's just less and less reason for a lot of these companies to be public.
That's a perfect segue, actually, coming right back to you, Ben, talking about strategy in this current environment. And I know you guys well enough to know that, you don't really divert too much from your core strategy and how you assess companies, no matter what the market landscape looks like. But Ben, for you in particular, I don't think a lot of folks have heard about, your strategy that you're coming out with Devonshire Partners. So, and I think it's very appropriate when you are kind of looking at the market and where things are with microcaps. So can you give us a little overview on your strategy and how you're looking at microcaps right now?
Yeah, and I did an hour today with Toby Carlisle on Value After Hours on this topic, so I'm going to try to be a lot shorter. I was a public market investor for 15 years, focused on small, mid, micro, so I lived in this space, and I saw opportunities for my previous firm to write big checks in the small and micro, and there was just a mismatch between the LPs we had and the ability to, and our desire to raise an SPV to do big things. And so that formed a strategy where we aim to be large check writers in a space where our thesis is that there's a structural lack of capital available to microcap companies, especially growth equity. And as rates have risen and the cost of equity has gone up, it just has exacerbated that problem. And so we have the big, hairy, audacious goal of being a shareholder of choice in this space, whether that's in the form of financing a company in public or in a take private. And I know a lot of the people in this room have probably thought about this strategy, of tinkered with it maybe in their own fund and strategy. We're not trying to raise a 40 stock portfolio of microcap companies and then do side pocket SPVs. Our main focus is just to focus on take privates in the space. And for all of the reasons that I talked about in terms of public company costs going up and the access to capital not being there, we want to be private equity oriented business builders who help management teams compound much faster, whether that's in a public market via some kind of, some kind of other, like a pipe or something like that, a friendly pipe, or a full take private. We want to be the shareholder of choice to that, where if a company ever wants to consider doing something, needs growth capital, believes that maybe the public markets is not the right place for their strategy, we want to be that first call. And so we're in the early stages of incubating that, and we recognize how hard it's going to be, but it's venues like this and meeting people here that kind of where we can get a lot of feedback on what we're doing, and it's so far it's been really positive.
Absolutely. You just answered my next question. I was going to follow up with how the feedback's been, so thank you for that. Positive. All right, one word. So, along this same line, not necessarily like I said, not necessarily the changing up of strategy, but maybe the universe that maybe you're now looking at in this current environment when you are evaluating new ideas. What is some of your criteria when you're looking at, potentially new ideas right now? So, Michael, you want to kick us off there?
Yeah. I'd say a new universe of ideas that I've looked at recently, and the last few years have been kind of funny, because if you think about what's worked the best, the sectors the last couple of years, it was natural resources, oil and gas, coal in 2020, 2021, 2022. Last year, there was a lot of success out of the financial sector with the ESIP bank trade that, a lot of people have talked about, a lot of high-performing insurance companies. And if you were to ask any microcap investor, prior to 2020, what are any sectors you avoid? Is there anything that, most of us are just high quality business investors. You look for high quality businesses, high ROE that can grow for a long time. What do you just categorically not look at? People would say, I don't look at natural resources, I don't look at financials, and I don't look at biotech. And biotech So it's funny that, natural resources and financials have done really well the last couple of years, and biotech is doing really interesting now. There's a lot of interesting stuff in the biotech liquidation special situation space that has had a lot of success in, I'd say, like the last 6 to 12 months, as the biotech market has turned from like a 5-year bear market to finally like starting to inch up a little bit. So I'm looking at a lot of stuff there. And I think just broadly trying to expand my horizons to not categorically write off any sector of the market, like, resources, gold, banks, whatever. China is also potentially something very interesting as that economy opens up, and, it's a difficult market because there's like a 50-50 chance you're investing in a fraud. But if you get it right, you get like 50% growers at 5 times earnings. That's a market you can still have that happen. But it's all in the early stages. But yeah, trying to expand the horizons, looking at a lot of biotech stuff, trying to look at other sectors that are usually more neglected.
Very cool. Sam?
So the question is, like, we're at what sectors? Or
yeah, what? Yeah.
To me, it's less about sectors. I think it's more, so, okay, let's talk about biotech. Like, how do I play biotech when I'm not a biotech investor? Well, all these liquidations are happening. Heritage Global is a company that's here presenting, right?
Shareholder.
And I'm a shareholder of that. They have a segment of their business where they, do these biotech factories or equipment liquidations. So that's my way of playing it. I also own another company called EasyPawn. EasyPW is the ticker, and I own that. And they're a pawn shop. So to me, that's like a hedge in a way. As the economy, I see it getting worse, and more people I talk to and the companies I talk to, things are softening up. So that's I like to play a lot in those defensive industries, and if I'm paying a fair price for them, or a good price for them, and I get upside where if things get worse, that's a place I look at. I also like to look at companies that have either missed earnings or they have some sort of hair on them, whether it's a lot of debt, SEC investigations, they're late on filing their Ks or Qs, things like that. I think that's also like an interesting sector where if a company is late on filing, I've seen them get hit 15-20%, and no one reads like what they actually write as the reason as to why they were late, and there's a ton of funds who can't hold them. So another example is a company, Payfair. They were late on filing, said that it was one of their, I own Payfair, just to be clear. They were late on filing, and one of their payment providers wasn't providing them with their audit, so their auditors couldn't file it. And they wrote that on multiple releases, and eventually, now they're announced that they're going to release on, I think, May 2nd. So, the stock went down 15%, and it's come back up, back to where it was before. So I think those are opportunities that I'm seeing right now.
Very cool. Artem?
So why would I invest in microcap company? Well, the goal /hope/dream, you pick your own word here, is to invest in a company early on that would have revenue, earnings, and free cash flow substantially bigger a few years later. And by substantially bigger, I mean 3, 4, 5, 10 times. Like, that's why you do it. So from that perspective, what I'm looking at has not really changed much today versus a couple of years ago when Bobby and I did our podcast. I still look at companies that have a product or a service that solves substantial pain points for the customer and therefore creates consumer surplus. Consumer here broadly defined, it can be a consumer like you and me, it can be a business. The company that has very attractive unit economics, meaning makes a lot of money on every single transaction or unit of something being sold. And that company has a substantial growth runway in front of it and will position to attack that. In the process of attacking that market in front of it, I want that company to be building its future competitive advantage because we live in the US and capitalist society and competition will eventually come. How do you do that? What does the team, including the CEO and everybody else in the organization, do every day to build that future moat? Is it customer lock-in? Is it building switching cost? Is it creating certain standardization and compatibility or incompatibility with other products? Like, how do you plan to defend yourself when competition will come? And then it's about whether you are probably, if you're small right now, you're probably subscale, meaning you may be having great unit economics on every single transaction, but you don't have enough of those transactions. So how big can you be in a few years' time, in a few years later, and how your margin structure and your financials would look like 3, 4, 5 years. That's what I do, and if I can buy those companies at substantial discount to what I think they will be worth a few years later, I will invest. So, and that's approach I don't change much depending on the market environment.
Very good. Hey, Artem, coming right back to you actually on this question here, and both you and Michael touched on this a little bit earlier, but I wanted to get even a deeper dive into it. In your opinion, how would you say CEOs' behavior has changed in 2023 and 2024 after a tough 2022?
Well, I already spoke about the cat, right, on the stove, cold and hot. So I would refer back to that cat. That's number one. And again, many CEOs had almost life or death experience in 2022 when they thought they may run out of cash. And very quickly, they used that. And I think it's as much about psychology and mental state as about rational financial analysis in Excel or whatever tool you use. Another observation that I have, I've noticed that some companies may have had that. And when I go back and look, let's say 2021, 2022, some of those management teams will be on the record speaking publicly about we will grow out of that debt, meaning we will create free cash flow and then we will pay it down, we'll do bank refinancing, et cetera, et cetera. And then fast forward a couple of years later, as soon as they hit free cash flow profitability or maybe even adjusted EBITDA profitability, which is a little bit still free cash flow negative, they run to the capital markets, raise equity, pay down the debt. And you go back and read transcripts from 2 years or 2 years and a half ago, and you see that management team saying that we will not do it. Obviously, smart people can change their minds. I accept that, myself included. But it really feels to me it was more being influenced by that life or death moment. So long story short, if you are executive team member of the MicroCap, many people still do not appreciate that your execution day to day is only part, call it 40 to 50%, of your journey of building a successful company and creating substantial wealth for yourself and hopefully for your shareholders. Another half is how would you be approaching capital markets? And unlike marketing, operations, or manufacturing, most CEOs, not everybody, but most, are competent in those areas because they have background. I don't think anybody teaches a class to CEOs and CFOs how to interact with capital markets, how you approach your fundraising, which providers do you work with. Because I strongly believe that in microcap world, there is a lot more signal and value that smart investors can capture and utilize the base rates in their favor than, let's say, in large cap. But nobody teaches that. So maybe, Bobby, you should launch CEO, microcap, Planet MicroCap, CEO and CFO Capital Raising and Capital Markets Academy.
And maybe it's in the works, you don't know. So, Sam, love to get your thoughts on this. I think you've done more one-on-ones with management teams than anybody in this room ×4. So, love to hear your thoughts.
I'd say the biggest shift I've seen is, growth is kind of less in favor, and generating cash has been, companies have been like, hey, you know what, we're going to show how profitable our business is. And I think that's been the biggest shift I've seen in management teams in the way they approach things, and that's assuming you can, be profitable. So, I think that's the shift, and I think the frustration from a lot of companies are like they're not getting the revenue multiples they feel like they should be getting, and so it's like, well, if you're not getting a revenue multiple, get your EBITDA or EBIT multiple. So that's the biggest shift I've seen.
There you go, Ben.
Yeah, I think there was post the COVID, time, and then the supply chain issues. I think a lot of companies had to reassess their ability to take pricing. I think most small organizations are not necessarily built with the processes and systems to capture pricing as fast as their input costs are going up, and that was exacerbated during the supply chain issues post-COVID. So I think there was, whether it was them buying inventory at very rapid rates to make sure that they could produce for their customers, or on the flip side, some of their customers over purchasing from them in order so that and juicing revenue for these companies, just to make sure that their customers had ability to sell to their customers. And I think all of that has normalized, and now companies are living with some level of persistent inflation and have really had to reassess their ability to compensate for that in their pricing. And so, I see a lot more of kind of a reassessment of the entire business model, the supply chain, the margin structure that that these companies can actually generate within an inflationary environment. So maybe a little bit of different path than these guys have talked about, but I see a lot of situations where companies were either over-earning or under-earning, and I think as an analyst and investors in this space, we need to try to figure out what their run rate margins are, and I think a lot of these small companies are still, trying to figure that out themselves.
Very cool. Mike, you want to close this out?
Yeah. I think echoing what Artem said about price discovery and, capital markets, understanding of microcap CEOs. I don't know if this is symptomatic of the current environment or just the type of investments that we're making, but we've been investing more in early stage stuff that's starting out, where the new management team comes in to take over a very small operating business, and they need to raise some money, they need to uplist, they need to reverse split, they need to get new investors on the register, like all of this sometime in the next couple of years. And CEOs at that stage are much, much more receptive to advice and actually will take the advice rather than just smiling and nodding when you give it, about capital markets and how to structure all of this stuff to get investors and do all of those things that they don't really understand. So, part of that also might be because price discovery is getting much, much harder, and you need to actually have a clean cap structure and be uplisted and all of this stuff in order to get a full valuation. But yeah, that's something I'd say has shifted a little bit. CEOs seem more open to taking suggestions and actually acting on them from investors.
Very cool. All right, I want to shift to my next topic, and this is one that Michael submitted that it's actually my favorite question that I'm going to ask everybody here today. And I should probably close with it, but I don't care. I just want to hear everyone's opinion right now. But Michael, you get the first stab because you submitted it. So, what would you say is your most controversial investing opinion right now?
Yeah. So if you think about microcaps and what makes all the opportunity in microcaps, the opportunity is because of two core reasons. One is that this space is illiquid, and the other is that it's stigmatized. Like you talk about penny stocks, it's like frauds, like a bunch of stuff you just write off. And it's very illiquid, so the big funds can't participate in it. The exact same parameters apply to day trading, but day trading is just more illiquid and more stigmatized, and I'd venture to say that most of the people in this room view it as a very negative pursuit in investing. And that may be the case, it's not for everybody, but as a strategy, it has the same core features as microcaps to generate potentially very high excess returns, in theory higher than microcaps, because it's even more illiquid and more stigmatized than microcaps. I would say that stigma tends to follow liquidity, and the whole buy and hold great, wonderful businesses over the long-term mantra is a very good idea for very liquid strategies. So Buffett, obviously, and very, very rich people. And that's why these strategies catch on. But just because there's a negative stigma associated with penny stocks and a negative stigma associated with day trading, doesn't mean that these things are bad in any way. They're not bad for the economy. They're not bad for the companies. In fact, adding liquidity to a company's stock will actually increase its valuation. So it's good if you want to do some mental gymnastics like that. But there's nothing wrong with these strategies. It's just that they're stigmatized because there's no rich people pursuing them because they're illiquid.
Michael, I'll take the blame for that. I haven't featured enough day traders on the podcast yet in microcap, so I'll take the fault.
I don't know how many there are. How many day traders in microcaps there are. It's the type of stuff you can only do with like 100K. It's probably just like some college kids in their dorm that you'd find that are doing this.
I don't know. My Uber driver on the way to the airport here, she was a day trader in microcaps. Actually, she mentioned a company that was presenting. It was
returns.
Crazy. She did very well. Actually, it was one of the companies that's presenting here. You'll have to see it tomorrow. Artem.
Did you invite your Uber driver to attend the conference and do one-on-ones on
Oh, of
Thursday?
course I did. Are you kidding me?
Great.
And to subscribe to every newsletter that people have here, of course. But Artem, same question.
Many investors and some capital allocators talk about how microcap and small cap, and I will use these terms interchangeably here, underperform the large cap, and how the mega caps are as expensive as they ever been or been only a couple of times in history. And microcaps and small caps are as cheap as they almost have ever been. And therefore, the conclusion that people derive that there will be substantial, hopefully, there will be some substantial outperformance for microcaps and small caps. And I do not believe in that argument at all. Here's why. I think the historical data shows that small caps tend to outperform big mega caps. And I think the structure of the economy and the structure of microcaps and small caps today is radically different from the way it was when that data was assembled and calculated and those historical time series were calculated. Why is it different? I think it's different in two different ways. Number one, and think about it as you're being squeezed from two sides. Side number one is more venture capital is available today in the US than it has been during those decades when the data was accumulated and calculated. That's number one. So more, there is very often, and it doesn't apply to anybody in this room, but very often there is an inverse selection. It's a lot more beneficial generally to raise capital from VCs than go public early. And that was not the case 30, 40 years ago. So you're getting squeezed there. And by you, I mean all of us as microcap investors. That's number one. Number two, and if you think, I believe, that is my hypothesis, that a lot of historical outperformance of microcaps and small caps was driven by the fact that a lot of what people call radical innovation or disruptive innovation was happening in those microcaps and small caps when they were public. Now it's not the case. So you're getting squeezed from the bottom. But you're also getting squeezed from the top. What I mean by that? I think the mega caps today in 2024 are a lot more innovative than the mega caps were in the 70s or 80s or even 90s. And there are many reasons for that. But one reason that I think not enough people talk about or think about is the mindset of those mega caps is a lot more entrepreneurial and a lot more venture capital mindset driven. And one of the reasons I believe for that is most of biggest companies today were venture backed. And they learned how to think in those disruptive innovation terms, what mega caps of 70s and 80s did not know how to do. And look at the board composition of many mega caps. Many people on the board coming from the best venture capital funds. So that's how we're getting squeezed from the top. As a result, I think we cannot draw historical parallels with historical performance of microcaps and small caps and apply them to today, because the structure, the qualitative characteristics of the issues in that space have changed dramatically. So what does it mean to me as an investor? So I don't invest only in microcaps, but I do invest in microcaps. So it means that I don't have the tailwind that probably was present for several decades when the data was calculated. So it's in many ways tougher, and you need to be a lot more discerning than you probably had to be, let's say, 20 years ago. So that's probably what I would answer to Michael's question.
Very good. We are going to do a pod just on that topic alone, I think, in the near term, because that is
Sounds
fascinating.
good.
Very fascinating. Ben?
I'm not sure how controversial this is going to be.
Give it a shot.
I think it's pretty. I mean, at least as I'm, kind of straddling the public and private markets. To me, what I see is that what used to be a public market premium that companies traded at in the small and microcap space has turned into a public market discount, and there are private businesses that trade with much more coverage from bankers and brokers, with much more capital chasing deals. These businesses trade at higher multiples, right? And so what used to be a benefit of being public versus private, the capital markets outside of the public markets had become so well developed, and there's so many middle market private equity firms chasing these deals, and the sellers have become so sophisticated, right? That traditional person who didn't recognize that private equity existed 20 years ago and sold his or her business to the first person who called, I think that person is now running a full process and has their deck sent out at 300 people. I don't think there are many microcap decks being sent out to 300 potential investors, family office investors looking in the space. So to me, the opportunity set that creates is that there are real businesses in microcap that trade at distinct discounts to where a business like that would trade in a well-attended private auction. But there are structural reasons why many middle market private equity firms do not play in this space. I think the perception that take privates are very difficult. It permeates the entire industry, and I'm not going to say that that's not an accurate perception, but I think it behooves anybody who's in the private equity space to continue to look at all of the opportunities in front of them, whether that's a private-to-private transaction or whether that's a take private. So obviously I'm speaking to people who are, for some odd reason, and like microcaps, and so in some ways I'm preaching to the choir here, but I just see almost a generational opportunity to buy real businesses that have been left for dead, as the institutional capital that used to be present in the microcap space has unfortunately come out of the space. And I'll just briefly touch on the trends that I see, and I'd love people's feedback on this. But when I started my career in small and microcap, it was a much more institutional strategy where the pensions and foundations and endowments were excited about this strategy. And in some ways, the pensions and endowments have gotten so large that microcap's no longer an institutional strategy for them. They have to write $100 or $250 million checks, and that just doesn't work in microcap. And I would, to some extent, Artem's point, mega caps have outperformed microcaps for so long that people think the entire space is broken. And so, getting to Michael's stigma, right, there are reasons why people have shied away from this space, and so that creates the structural lack of capital that for a patient owner of these businesses who has access to capital and take private capital, I just think there could be a really good generational opportunity to buy some of these businesses and to grow them much faster in the private markets.
Very cool. Sam, close us out.
Sure, I'll be kind of short and sweet with my what I think is different. And I would say I like investing in regulated industries and businesses, and a lot of them are kind of like, I don't know, maybe people consider them like sin type of stocks or companies. We're in Vegas. I love the gaming space. Very highly regulated, creates nice barriers to entry. Galaxy Gaming, which I own, and I replaced Jason Hirschman on this panel. I think he's a fan to some degree. That I think is like a very, very high quality business, and a lot of it is due to the regulations in the space. To have your game approved in multiple states, costs a lot of money, and takes a lot of time as well too. So that's just to get approved to be able to have your game in that state. Now you got to go sell. I also like I mentioned, like the pawn business earlier. These type of businesses, I think, have a negative stigma to it, and I think if you're a very good capital allocator in that space, it can create a lot of value. And I think that's the value of being a small microcap public company, is that when your stock is cheap, you can buy it back. If you're private, you can't have that opportunity. When the stock is expensive, now you can raise capital, and if you can reuse that capital and invest it and get buy something cheaper, right? I think that's how you can really compound your money very fast as an investor and as an owner of a small public company. I agree with Artem on a lot of stuff. Like part of the problem with regulated businesses and industries is that the big players are the ones that can afford to pay lobbyists and get kind of what they want, right, and squeeze out the little guy to some degree. But a lot of other times, the little guys, there's not many of them in the space, and they can kind of ride on the coattails of the big guys too. So I'd say that's my controversial-ish topic.
Very good. All right, so I got one more question because I do want to open it up to Q&A and make this, bring everybody even closer in here. So final question for you guys, and you can quick, 30 seconds to a minute on this if you want, is, we're still about 8 months to go here in 2024. In your guys' opinion, what trends, news stories, catalysts are you looking out for or capturing your attention items? Are any of the following that you think will have an impact on 2020, on the rest of 2024 and beyond? We'll go all the way back. So Sam, you start, and then we'll go back.
I think the impact is, I think it's been brought up a little bit here.
Yeah.
As debt starts coming due and interest rates are higher than they were before, I think that's going to be an issue for a lot of companies and how they get out of that. It's going to be interesting. One of the things that I've been looking at, and I've done a few deals in the past, and I think there's going to be more opportunity, is structuring interesting deals with companies where, as an investor, you can try to protect your downside and then kind of get some upside, maybe like some convertible debt, or play around with different parts of the capital structure. I think that's going to be kind of interesting, and I think there's going to be a lot of good opportunities there to work where it's a win-win for both investors and companies. I think that's kind of the big thing for me.
Sounds good. Ben?
Yeah, I think piggybacking a little bit on what Sam's talking about, there was a perception that higher interest rates were going to break things in the economy and break things with the companies. And we saw a little bit of that with Silicon Valley Bank and First Republic last year. The banking industry was upside down in certain areas, but we haven't really seen the impact of higher rates, I think, on a lot of smaller companies. Maybe they had financing that was fixed, and now they're going to have to move to floating rate financing. And if you're playing 6% fixed rates and then you're going to play SOFR plus 5, that's going to create a lot of pressure on free cash flow. And for a company that didn't look particularly levered because they were generating free cash flow, right? If all that free cash flow gets sapped away by higher interest rates and refinancing, right, you're going to have a lot of zombies in this space. Businesses that have a reason to exist but have capital structures that just make no sense, and there's never any hope of paying off the debt. And the ability, as Artem was talking about, to grow out of that and to be able to reduce that, and in a way that really reduces the debt burden. I think it's going to be kind of rare if that actually works. So my sense, and we're not restructuring experts, and I think we'd be very cautious about playing in a super over-levered situation. But I think restructurings, interesting financings like converts, and if the equity markets aren't open, I don't even know what's going to happen to a lot of these companies. But I think this is a slow-moving train wreck that we are going to see smaller companies have to deal with, maybe disproportionately relative to larger companies.
Artem?
So there are two types of microcaps. So type number one, you start a small microcap, you keep growing your business, your market cap hopefully grows with it. And you go from small to a little bit bigger, and you grow that way. And there is second type of microcaps where you used to be a big company, let's say 2 billion plus market cap, and then you become a microcap because your market cap went down. And historically, most of those reverse microcaps, the way I call them, got into microcap space because their business became, at some point, a multi-nice cube. And it doesn't take a genius. If you take financials and operating metrics for those companies, you will see that revenue has been declining, profitability has been declining, operating metrics such as number of customers or whatever else you use has also been declining. So investing in multi-nice cube is not something that you generally can do well. However, over the last 2021, 2022 to a small extent, we got a lot of companies that started their journey as public companies at 1 billion, 2 billion plus valuation in the public markets. If you fast forward to today and you look at their revenue metrics, profitability, operating metrics, they've actually increased over the last 2 or 3 years. However, because they went public in 2021, often at the peak of valuations, which is good for them, they raised money and filled their coffins, their market cap is tremendously down, often 90%. So now it's a microcap. Welcome to the club. However, the business has performed well. There were just enough generous, well-meaning people who were willing to pay, I guess, 10 times higher prices back in 2021. So I think a trend, one area where I do like spending time is looking at those companies. The main challenge with them is that often the management teams of those companies still think of themselves as 2 billion plus market cap company, even though they're not anymore. And they want to talk to very big hedge funds running several $billion. And management teams of those companies often do not understand that they are off the list, they're off the menu, they are not being served at Italian restaurant or Japanese restaurant for those investors. You need now to talk to smaller managers such as Caro-Kann Capital. So sometimes getting access to them is actually kind of difficult, which is mind-blowing to me. Like, we can genuinely become your long-term 2, 3, 4% shareholder for the foreseeable future. Sometimes it's difficult to get them on the phone. So, but that's an area where I think it's interesting. Those reverse microcaps that got to become such, not because of operating difficulties, but because crazy overvaluation that they got in 2021.
Very good. Mike, close us out.
Yeah, I'd say echoing the past comments, I'm curious to see how in the next couple of months microcaps are able to raise equity. And it's not necessarily bad if like the market remains like it has been sort of cut off, because we've done more direct placements recently than in the past, and part of that is probably because these companies can't really get any money anywhere else, so they're forced to come to us. But yeah, besides that, I don't follow the macro stuff too closely, so I'm not sure about interest rates and any of those effects, just like the rest of us waiting for the bull market to start again.
Very cool. All right. Well, thank you all for your insights, and I'd like to open the floor for Q&A. So anybody have a question for any of our panelists?
Hey,
Stall.
particularly
No,
Michael and Artem, you guys talked about how companies kind of missed the window in 2021 and have been aggressively raising. And I was wondering your thoughts on share buybacks and microcaps, because often we all look at microcaps, everything we own we think is undervalued, and we generally want them to buy back shares if they have the excess capital. But I hear from lots of management teams, hey, my stock's already really illiquid, or I bought back 6% of my company last year and the stock didn't do anything. So I'd love to get your thoughts on share buybacks in smaller, more illiquid companies.
I'd say, in my experience, if a company really wants to buy back a ton of stock, they can do a tender or a bigger transaction. A share buyback, broadly speaking, in the stuff that I've looked at, is more for show and demonstration that there's a floor on this stock, it won't go down forever, give the existing investors assurance. But if you're really, really trying to play the capital allocation game, I would ask a company if they would be doing a tender instead, like put a meaningful amount of money to work all at one time. A buyback really won't accomplish that because of the liquidity reasons that you talked about.
So the pushback from management teams about not doing buyback because my float is very low. My banker told me that if I reduce the float even more, I will not be investable for many other funds. I think this is a very... I'm looking for the most polite word that I can come up with on the spot. Let's call it short-sighted point of view. First of all, what are you trying to optimize for? Are you trying to optimize for the average daily volume, called ADV, or free float? Or are you trying to optimize for creating wealth for yourself? Because probably if you're a microcap company CEO, probably also substantial shareholder, and any other shareholders who believed in your company and you. So if you're trying to optimize for EDV, yeah, don't do buyback. If you're trying to optimize for value creation, then you should be doing buyback and not listening to those bankers. So that's number one. Number two, most CEOs still do not understand share buyback. They view it as, we will provide a floor, we'll show that we're there. No, you're not doing that. You're doing that because you are being offered to buy Ferrari at the price of Toyota. Will you do that deal? Probably every single day. But most management teams don't understand it. And point number three, this is where the dividing line comes between top A players who would play eventually in major leagues and also just runners-up and wannabes. Most people don't get it.
I would just add to that, my own personal experience is that most management teams that are good at running businesses and growing businesses are not good investors. So they typically buy back their stock at the worst time. And so as an investor, you're like, okay, share buybacks are good, but at the right price, right, at the right valuation. So that's a different skill set.
I just wanted to ask Ben a question about his strategy of take privates and what you're doing there. One of the kind of core features of traditional take private is a stock that it does not have a lot of volatility in it, right? So that's easy to negotiate a price with the management team, and then at the same time you want to have consistent cash flows that you can use to pay back debt. I'm curious as to how you think about that, because so many companies in the microcap space, as Sam pointed out earlier, they're going up and down, 20%, on any bit of news or maybe no news. And at the same time, also, a lot of the reason why these companies are interesting in microcaps is because they have a growth trajectory, and their idea is we're going to grow by 40% every year, and so maybe they may not have the cash flow profile or that you would traditionally associate with a take private candidate. So I'd just love to hear a little bit more about how you approach those two issues. Thank you.
Yeah, I think when you compare a transaction, a private transaction in the lower middle market to a take private, there is no comparison. In the former situation, you are negotiating with a business owner, maybe someone whose kids are not in the business, and there's a single decision maker, right? In a take private transaction, you have outside shareholders, you have a board, you have a group of, agents, maybe there are principals, but to some extent, the C-suite is a bunch of agents. And so you've got a lot of different desires and needs and opinions that you have to cater to. And in addition to that, of course, you're dealing with volatile stocks that, you could start negotiating a transaction and then whether it could go up or it could go down a lot, right? Like that volatility. So the way that I would look at that is that, we are focused on intrinsic value, right? And we are focused on, what we would pay for a business, and we have to be willing to let, deals go by and be very judicious with what we're willing to pay, because, generating returns in any environment is hard, but especially if you're doing a take private, if you're paying a control premium, I think you have to be very careful. So I don't think there's a perfect answer for how we're going to mitigate that. I mean, we've seen recent deals in the microcap space. One of the ones that I looked at, the stock was like $4, and they took it private at $3. Right, as a take under, right? So that lack of liquidity can be a friend, or it can be the foe of a strategy like ours. And I think the idea is that you have to be a patient buyer and be really judicious with your price. Sorry, your other question was about the. Remind me the second part.
Yes, we had the liquidity, and then whether these companies.
Sure. Yeah. So I'm actually looking for bad public companies. What does that mean? Doesn't mean it's a bad company. I'm looking for companies that don't fit the profile of a good public company. And a good public company, in I think a lot of people's eyes, is something that grows consistently at a very straight line rate, that generates predictable cash flows that aren't lumpy whatsoever. even in microcap, a business like that would trade at a nice multiple because people like certainty. And so I am all for a business, that can maybe grow at an irregular 15% over a business that grows at a straight line 11. And my belief is that business that grows at a straight line 11 trades at a much higher multiple than the one that does at lumpy 15. So we're not, the idea is business building here, right? And as opposed to financial engineering. So the leverage profile of these that we're going to put on these companies is going to be very light, so that we can invest in a lumpy business, right? And we don't necessarily need to have this perfectly predictable cash flow company where we have to pay a high multiple. And then how do you even get the IRR you need? You need to write the skinniest equity check possible. Right. And I just think in this environment with rates where they are, that is a really dangerous and possibly, value destructive strategy. So buy a good business that maybe is lumpy, not a perfect public company, pay a fair price, and, let it compound outside the public markets.
Very cool. You know what? We're about 5 minutes away from 7, and I think everyone in this room is ready to network and get out there at the Paris Hotel pool. So I think we're going to close it out with everyone's website where people can go and find more information about you. So, Michael, where can people go and follow you on social media and more information on Intelligent Fanatics Capital Management?
Yeah, I'm on Twitter, Michael2017L, Michael Liu, add me on LinkedIn. My fund is if.capital. You can go and find all the information.
Cool. Artem?
You can find me on LinkedIn, Artem Fokin, or you can go to Google, type Artem Fokin Caro-Kann Capital, and the website will pop up. I have a Twitter account, and I think I made only one tweet in my life, so probably not the best place to reach out to me there.
Ben?
Like Bobby, I am everywhere. So devonshirepartners.co. You can find me there. At Twitter. Twitter's at Ben Claremon. I'm also the host of the Compounders podcast.
There you go.
Bobby and I do that together. And I also have a Substack, Compounder Substack. So if you want to see anything about our strategy or what we're doing, in addition to following the podcast, go to the Compounder Substack as well.
Cool. Sam?
You can go to ridgewoodinvestments.com. I don't know what Substack is. I'm not sure.
Get out of here.
I've heard of the term. I think there's, I guess you could find Ben's info there. And so we're an RIA also. So if a lot of our assets are under high net worth individuals, we manage their whole investment portfolio, not just small and micro caps. That's just a small sliver. So go to ridgewoodinvestments.com. You can learn about our full investment advice strategy there.
Very cool. And if you don't already follow, Planet MicroCap podcast is available wherever podcasts are available, as well as on our YouTube channel, Planet MicroCap. So thank you all for being here. Thank you to our panelists. Let's go have a drink. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.